Okay, so in this class, we are going to discuss about home, auto, and mortgage insurance. I'll give you highlights of it first, right? Then we'll do like best practices, and finally, we'll cover the PowerPoint. So, first thing first, what is the concept of insurance? So, insurance is a way of covering your risk. Okay, insurance is a way of covering your risk. There are other risk handling mechanisms like self-insuring, that is building up a corpus, building up funds so that if anything happens, you can use those funds. Or there could be a risk reduction mechanism, risk avoidance mechanism. Insurance is a mechanism of covering your risk, that is transferring your risk for transferring your risk to an insurance company. So when you buy an insurance, you transfer your risk, you give away that risk to the insurance company. How do you do that? By paying a small premium. So you pay a small premium and you give away your risk to the insurance company. That's the basic concept of insurance. So there are different players. There is insurer, the person who buys insurance. There is the insurance company who gives out insurance to you. Okay, so insurer pays premium. Okay, insurance company gets premium. Now premium is usually paid monthly or annually. The two common ways of paying insurance premium is monthly or annually. Insurance company gets that premium as an income monthly or annually. Now, why are they taking your premium? They are taking your premium to, right? They are taking your premium to cover mentioned risk or pre-decided risk. Example, if you have a car, you're driving it, you take auto insurance, right? So you pay premiums to an auto insurance company. That auto insurance company gets your premiums, and what do they do by taking your premiums? They agree to cover your car if something goes wrong. So if you're in an accident or like something happens to your car, then whatever is the expense to repair it or for you to get a new vehicle, that part would be covered by auto insurance company, that insurance company. And to do that, they take premium. So they pay in case of certain events. So if certain event happens, they pay you back. So this is the basic like 360-degree overview of insurance. What is insurance? You pay a premium, you get insurance coverage. Okay. What is insurance coverage? The insurance company agrees to pay you if something goes wrong. Okay. Now, there are different types of insurance. We are going to discuss home, auto, and mortgage insurance, not in this order. First, we are going to discuss home insurance, then auto insurance, and then mortgage insurance. Now, there are two types of home insurances. So, first type is the type that you can get for condos or townhouses. Okay. So first type of insurance you can get is for condos or townhouses. So condos and townhouses generally has a condo board that takes care of external repairs. We discussed this in real estate. So when you buy a condo, right, or when you buy a townhouse, there is generally an condo board that will take care of external repairs or external damages that might happen to your property. And usually the condo board also pays for insurance, so they get their own insurance. So you don't have to worry about the exteriors, you have to worry about interiors, like leakage inside your home, that is your fault, right? Or fire hazard inside your home, something like a burglary or something like that, that happens inside of your home. So townhouse or condo insurance generally covers only interiors. You can optionally get an exterior insurance for your condo or a townhouse, but most of the times it is not needed because the condo board is going to cover your exteriors. So only interiors you need to insure, and you can get it using a condo or an apartment insurance. Okay. Now it usually costs less. It usually costs less than like a detached home insurance. The reason is the exteriors are covered by the condo board. The insurance company doesn't have to worry about that, so they will charge you a lesser premium since only interiors are covered. Okay. And they also cover liability. So home insurance has also liability coverage in it. So I'll explain what is liability coverage. Liability coverage means if something happens to a person while he or she is visiting you, then it is, and it is your fault, right? Then it is your liability. So if it happens in your house, then the liability insurance takes care of that, right? So this is liability coverage that might be available along with home insurance. It's a good idea to check with your insurance company and always get a liability coverage. Liability coverage is not for yourself, it is for someone else that might be caused harm because of your intentional or unintentional actions. Okay. So that is liability coverage. So home insurance, first type, condo or townhouse insurance, generally less costly because only interiors is what the company covers, and it might be like accompanied by liability insurance. If it is, it's a good idea. Okay. Any questions so far? Okay. Second type is a detached home insurance. In detached home insurance, the insurance company covers exteriors as well as interiors. Okay. It will cost more. The detached home insurance is usually more than getting a comparable insurance for a townhouse or a house. Okay. It might also be accompanied by liability coverage. Same thing. Liability is for someone else to whom you have done harm intentionally or unintentionally. So it might be also attached with like liability coverage. Okay. It covers exterior as well as interior. It usually will cost more. Then there is third type of insurance, tenant insurance. Tenant insurance is usually for people who are renting. So if you are renting, it's usually a good idea to get this insurance. It covers your belongings, okay, and liability. It generally covers whatever belongings you have in the rented place plus any liabilities that might arise because of renting. Okay. It is the cheapest form of home insurance. The rental insurance is the cheapest form of home insurance. Okay. So three types: detached home, right? Then townhouse or condo, and tenant insurance. So this was the first concept. Second concept, how can you get an insurance? Now there are multiple ways to do it. You can buy it online, you can go into a bank to get it or an insurance company to get it, or you can go through an agent slash insurance broker. So you can buy an insurance online. You can go into a bank or an insurance company to get the insurance, or you can buy it through a broker. Broker usually has insurance from different companies. Usually in online you do not have to pay commissions because you're not going through a third party. You're directly going to the company and buying insurance from them. So usually it will not have commissions involved in it. But when you buy it using a bank or using an agent or a broker, then commissions might be involved, and that's the reason it could be little bit more costly. For broker there is an advantage. They can guide you with in terms of insurance and also help you to decide, right, how much insurance you need and where is the cheapest possible option. Okay, so you can buy it online, bank and agent. Now online there are multiple ways. I'm just going to show you one. So if you see TD insurance, okay, get a home quote. So let's say you're a condo owner, you're in Alberta. So I'm just typing in some random address I know. Okay, so let's say coverage is starting right now. So it will ask you if your home as a business or you're renting part of it. And never lie on insurance, because if they find out that you are running a home business or you are renting part of the property, then they might deny your claim. So let's say we are not renting. We have bike worth $2,000, $1,500, let's say. Apart from that, there are not much valuables. Okay, let's say $2,000. Okay, so you will get additional savings if you have like these installed, like fire system, anti-theft system. So if you have none of the above, right, you have zero claims. Let's say you're just starting the house. So if you have, if you are existing TD customer, or if you have a mortgage or own line of credit on this property, right? So let's say we have a line of credit or a mortgage on this property, and next if you click, I'm just typing in random names, and you can look at it later on. I'm just showing you. So it will calculate a premium for you. So you have to pay $77 to almost monthly to insure your house. That will cover 30,000 worth of belonging, right? $300,000 worth of damages. Personal liability, they are giving $1 million, right? There is a deductible of 1,000. We'll discuss all of this. There is water damage coverage, like bike and stuff. So it will cost you $77 to cover it. Okay, so this is an example of buying insurance, home insurance online. TD I'm using because like I generally insure with TD. So you can choose whatever you want, but this is one way of doing it. So three ways: online, bank or insurance channel, and agents and brokers. Now, what is your home insurance premium dependent on? So your home insurance premium depends on a lot of things. It will depend on type of your property, Okay, then it will depend on age of your property. It will depend on location. Okay, it will also depend on, right, protections that you have for the property, like smoke alarms, like fire alarms, then a home safety system, right, etc. If you install all of this, the premiums will be little lower. So home insurance premium depends on a lot of things, like type of property. Houses are expensive, apartments are cheaper. Age, if the property is really old, then the insurance will be higher, right? If the property is newer, the insurance will be lower. Location depends on a lot, right? If you're located in downtown where like vandalism rates are higher, then the insurance coverage will be little bit higher, right? Protections that you have, if you have fire systems, if you have like gas leak systems, the home premiums will be little bit lower. Okay, any questions so far? Next is, what are the best practices? Now, first best practice applies to all types of insurance, but especially to home insurance. Don't lie on your insurance policy. So don't lie. Like for example, if you are saying that your place is not rented, then it should not be rented, because if you rent it and do not inform the insurance company, and if something happens to your place and they investigate and they find that you are renting the place, so that claim will be null and void. So they may deny you your claims. So never lie on insurance. So first thing, if your place is rented, tell them that it is rented. If you're running a home business, tell them that you're running a home business. Okay, so one more thing, a home premium also, house premium also depends on, right, whether you're renting may will make the insurance costly. If you're doing a home business, that will also lead to costly insurance. So don't lie on insurance, like home insurance policies. Second thing, usually if you get home plus car from the same company, you might get discounts. So if you buy your home insurance and your car insurance from the same company, they usually give a discount to you. Okay, so that's the second point. Third point, okay, if you have higher deductible, then insurance premium will be lower. Deductible in insurance means, deductible is if the claim arises and if you have, let's say, $1,000 of deductible, then whatever is the claim, out of that $1,000 you are paying, rest of it the insurance company is going to pay. So that is a deductible. Yeah, there is also co-payments. Co-payment is you pay a percent, let's say 10% of the claim, rest of it insurance company is paying. So if you have higher deductibles or higher co-payments in insurance, the premiums will usually be lower. So figure out how much money can you pay from the pocket, right? Keep it aside, have it as deductible, and you might be able to lower your premiums. Usually, like I have $2,000 as deductible, so if something happens, I'm okay to bear it up to $2,000. But if it is more than $2,000, then, right, I want my insurance company to pay. So in that case, if you change the deductible to $2,000, your insurance premium will be lower. So maybe I can show you here. So if you do edit coverage, and if you increase the deductible to 2000, Okay, they will recalculate and they will lower your premium. So your premium goes down. It was $78 or something. Now it has gone to $72. Right? So if you go back, I have to change it again. So if I change it to 1,000, so with $2,000 of deductible, it is $72. But $2,000 deductible means if something happens and you have a claim, $2,000 you are paying. Everything else, like if the claim is more than that, then the insurance company will cover you. Okay, so if you make it $1,000, the premium will be different. So if you recalculate, it is $76. So around $4 or something you save by having a higher premium. Now it's a call. Like, are you okay to put in $1,000 extra if the claim arises? Okay. So that's also something you might consider. Okay. Then installing systems, right? Protection systems like anti burglary, then let's say anti-fire. So if you install all of these systems, whatever the insurance company is mentioning, usually the cost of insurance goes down. So if you have these systems, cost of insurance usually goes down. Then if you are staying with them for longer term, they might start giving you discount, but you have to start negotiating with them, right? The longer you stay with an insurance company, usually you are able to get better rates and better discounts with them. Okay, but you have to always ask. They will not do it voluntarily. Okay, then sixth one, sometimes if you pay in annual terms, you might enjoy certain discounts. So if you're paying them monthly, it depends on insurance companies though. Some insurance company do not penalize you for paying monthly. Okay, some insurance company gives you a discount if you're paying them annually. So check with the insurance company. Most of the times, if you're paying annually in one go, the entire year's premium, then you get discounts. Okay. So these are the best practices. Don't lie, right? Home plus car, if you get from the same company, you get further discounts. If you have higher deductible we discussed. Deductible is part of the insurance claim that you are supposed to pay. Installing protection systems, if you have longer term with them, if you have long relationship with the insurance company, then, and if you pay in full annual terms, you might get certain discounts. Any questions so far? Okay, now the seventh best practice is a little bit what we are going to discuss. Always get liability insurance and try to have at least $1 million. Now, what is liability insurance? If you get sued for something, right, then that's considered as as a liability. It may be your intentional fault or it may be non-intentional fault. But if you get sued and there is a personal liability, then insurance, like home insurance, part of home insurance covers for it. So it's a good idea to get a home insurance liability coverage. Because I'll give you an example. So let's say you have a summer barbecue and people are visiting you, something happens to some person and they sue you back, right? And the court finds out that you didn't follow certain norms, or it was too dangerous for them or something like that, then you are liable to pay them damages. So in that case, insurance, like liability insurance, helps a lot. So always get liability insurance along with home. Okay. Now the next point, if you're renting, it's a good idea to look at tenant insurance, because tenant insurance is really cheap. But if something goes wrong, right, tenant insurance is a big help. If something like, because of you, if something happens to the place and the landlord like ask for damages and stuff, then it's a good idea to have tenant insurance to cover for that. So any questions with home insurance? Okay, so I'll highlight that. Then the next one we are going to discuss is mortgage insurance, also known as credit insurance. So what is the basic concept of mortgage or credit insurance? So when you buy a house, you might take a mortgage on that. Now, mortgage or credit insurance does not protect your house. It protects the bank from you not paying. So mortgage or credit insurance is actually the insurance that you buy for the bank. So if you're not able to pay mortgage, because of two basic reasons, that is, something happens to your life or you have some kind of disability. So if something happens to your life or there is some kind of disability, then the insurance company, the mortgage insurance company pays to the bank. Mortgage insurance company pays to the bank. So your mortgage is taken care of. So it's like a life insurance, but it only covers your mortgage. So you take, once again, you go to a bank, you buy a house, you take a mortgage. They will ask you whether you want a credit insurance on that, that is a mortgage insurance on that. So if you say yes, and then you have to pay a small premium, right? And they will cover, right, that mortgage for you. So if something happens to you, aka something happens to your life, or something happens to your, like some kind of disability happens, then, right, the bank will take care of that insurance, like that insurance company will take care of that mortgage, right? You do not have to worry about that. So it's kind of a safety mechanism. Now usually that's the same thing that a life insurance does. Life and disability, if you get life and disability, we'll discuss it in a later video, like later chapter. But life and disability insurance is kind of that. If something happens to you or some kind of disability happens, then the insurance company will give you money. That money you can use to then pay, like that nominees can use to pay off the mortgage, your family can use to pay off the mortgage. So it's similar, but credit insurance only covers mortgages. Life insurance will give you a payout irrespective. They don't worry about what the family does with that, right? So life insurance is also a possibility. Now it's not a good idea to take mortgage insurance if you have life insurance, because the purposes are same, and mortgage insurance is usually more costly than life insurance. Mortgage insurance is usually more costly than life insurance. Okay. Also, mortgage insurance, one big drawback it is the mortgage will keep on going down, but the premium stays same. So premiums stay same even if you are paying mortgage. You are paying off your mortgage. So that's a big problem, that you are paying a monthly fee, but the mortgage is going lower and lower because you're paying it off, but the monthly fee will stay the same. So it's not that useful. So better way to cover your risk of life or disability or even critical illness is to take an life insurance, a disability insurance, or a critical illness insurance, rather than going for mortgage or credit insurance. It is very costly, right? I usually do not suggest like my clients to go for it. Any questions? Okay, the third key point is auto insurance. Now what is an auto insurance? If you are having a car, driving it, right, then you are legally mandated to have auto insurance, like third party at least, and then you might get additional. So auto insurance is divided into two parts: third party liability, which is mandatory by law, and then comprehensive or collision, that is not mandatory. Okay, so there are three parts to driving a car. First part, when you're driving a car, you might cause damage to someone else. Someone else can, like in terms of life, disability, or property damage. So you're driving a car, you hit someone, right? Either their car gets damaged, they get damaged, or they have a life threatening emergency. So in that case, you need third party insurance, third party liability coverage. Third party liability coverage means if you're causing harm to some third party because of your driving, right, then that part, that insurance covers you for that. Now that insurance is mandatory by law. It is mandated, right? It's mandatory by law to buy this insurance, buy this third party insurance. Okay. Now the second damage that can happen is to your car. So if you're driving, you hit someone or someone hits you, you can have damage to your car, right? It can be due to collision or it could be due to some other factor. So collision insurance covers damages that occur to your car, right, from someone else or you driving. Okay, this insurance is not mandatory by law. Good idea to get it, but it's not mandatory by law. The third type of insurance is accidental coverage, that is damage that happens to you, the driver, or passengers. So once again, imagine a person driving a car. That person can cause damage to someone else, right? Property, life, or disability. That gets covered by third party liability provision of an auto insurance policy. You're driving a car, right? Something happens to that passenger's car, right? Maybe the mirror breaks off or there is a collision, something like that. Then the comprehensive or collision part of that insurance will pay for, right, the damages, right? And accidental coverage means the passenger is driving the car, something happens to him or her, like a life threatening situation or some kind of disability, then the insurance will cover for that. Okay, so when you buy an auto insurance, there are three parts to that insurance. Okay. Any questions so far? Now, once again, how to buy this? Now, you usually buy auto insurance from the same in the same way that you can buy home insurance. So you can buy it using online, you can buy it using a bank, or you can buy it using a broker or a agent. Usually online you will get certain discounts because the company, insurance company, doesn't have to pay for a broker or an agent. Again, once again, you can buy an auto insurance either online using a bank or an insurance or broker. The auto insurance is very expensive. We'll first discuss what it depends on, right? So before that, I'll show you how to buy it quickly. Okay, so I'll quickly go to Google TD auto insurance. Okay, so you have to put vehicle here. So let's say it is 2021. I'm just putting some random numbers in, something that I know. The vehicle is, let's say, new. It is owned. Date of purchase, let's say this is the date. I commute to work. Okay, so if you are just using to commute to work, okay, and annual estimated distances, usually people drive somewhere between 15,000 to 20,000 kilometer on an average every year. It can be less, can be more. I'm going with the average 15,000, right? I commute to work or school every day. I drive, let's say, 50 kilometers. Okay, they are saying increase it if you're driving 50. So 30,000 kilometers you drive, 50 kilometers per day. If you're using the car for business, the insurance will be higher. Let's say we are not using it. Coverage starts right now. Do you have any anti-theft features on your vehicle? So if you have some protection features, anti-theft features, the cost will be low. So no. If you are like belonging to certain professional groups, they might give you certain discount. Also, if you are a university student or like studying in SAT or something, you can get certain discounts too. So let's say no. So use your license. So they will ask you license information, so you have to fill it. I don't have my license on me. So AA 1 2 3 4, let's say. No, they will not take it. No, I need my license for it. I don't have. Use your information, let's say. I'm just putting a random date. Married. Okay, this is important part. Now, depending on what type of license you have, your premiums will be determined. So there are class 5G, class 7, the insurance will be very costly. Class 5 GDL and class 5 GDL means you do not have a complete license. Class 5 GDL mean class 5 license means, right, you have a complete license. Okay, this is learning license, but you can still drive on your own, but it is midway between a learner's and a full license. Class 5 is full. In Ontario and stuff, they have like the G and GDL system. In BC it is class 7, so it depends on the province, but let's say class 5, so 20 years, let's say 20. If you get more, like if you have past tickets and stuff, the insurance cost will be more. If your driving license is suspended, then the insurance cost will be more. If you have like auto insurance coverage in past, no, let's say if you make claims on insurance, the insurance goes up, any kind of insurance. Okay, I'll just put the number, email address, I agree, and let's say calculate your premium. So your premium will be $273 per month. So this is the way of buying insurance. Like online, it's quite like you can do it very fast. Always check online first, and also if you want to check, you can check with brokers and stuff. If they give you a better rate, then you can go with them. Okay. Now your auto insurance premium will depend on a lot of things, but these are like few things that auto insurance premium depends on. So first thing, it depends on your, let's go with you first as a driver, and then we'll go with other factors. So first thing, it will depend on driving history. The longer you drive, lower will be the insurance cost. If you're a new driver, the insurance cost will be higher. If you are a seasoned driver, the insurance cost will be lower. Second, it depends on type of insurance, type of driving license. So if you have a full license, the insurance cost will be low. If you have a like GDL kind of license, the graduate license, right, means you have given the exam, you have cleared it, you can drive on your own, but you do not have a full license yet, then in that case the insurance cost will be higher. So if you have, try to get a full license so that your insurance cost goes down. Okay, so driving history, type of driving license, then third one will be, okay, past driving behavior. So if you have a lot of speeding tickets, the insurance cost will be higher. If you have a lot of parking tickets and stuff, insurance cost will be higher. If you have done traffic violations or shown risky behavior, the insurance cost will be higher. But if you have none of these, if you have never had any traffic ticket or something like that, the insurance cost will be low. Fourth one, your suspension of license. If your license was suspended in past, then the insurance cost goes up significantly. If you have no suspensions or no demerit points because of your driving behavior, then the insurance cost goes down. Okay. Fifth point, they some insurance companies give you an option to put monitoring devices, especially Intact and stuff is known for that. So they ask you to download the app, and that app will monitor your driving behavior, how fast you drive, whether you follow speed limits and stuff and such. So if you sign up for that and show good behavior, right, then you can get certain discounts. So good idea to look into that. So this is driver based. Your driving history, type of driving license, past behavior, suspensions if you had any, monitoring, if you accept to monitoring devices, also past claims. In home and auto both, if you have past claims, the insurance goes up. So it's a double-edged sword. So if you file a claim, right, then most of the times you have deductibles and stuff, so you have to pay from pocket, plus the insurance cost might go up because of that. So past claim also influence auto insurance premiums. Then it is also based on car and policy. So the more costly the car, so cost of car determines cost of insurance. If the car is very expensive, it's a vintage car and it's very hard to replace parts of that car, then the car insurance will be higher. So lower the cost of your car, lower will be your insurance premium. I am not a big proponent of expensive cars, and car is for a person to get from point A to point B in the most efficient and like safe way. So if you're like fulfilling those qualifications, not a big proponent of expensive cars. Expensive cars are very like will lead to expensive financing if you cannot pay from pocket, or expensive cars will also increase your insurance cost. So not a big proponent, but cost of car is a determining factor of your car insurance policy. Second, the model and type. Now models that are easily like the parts of which are easily replaceable, like Toyotas for example, usually have lower insurance. Toyotas are known for, or Hondas are known for lower insurance because this is a popular model, it's a widely available model. So in that case, the parts will be easier to source. So if something happens, the insurance company has to bear lesser cost. So in that case, the insurance premium will be low. But if you're buying, like, let's say, a Tesla or something, the parts are like expensive to source, so the insurance cost might be higher. Okay, then amount of driving, that should come in driver, so we'll write it down here. So let's say miles or kilometers driven. If you're driving a lot, then the insurance cost will be higher. If you're driving less, the insurance cost will be lower. Then also we'll write it down here. So driving determines the kilometers you drive will determine that. Then the next part is related to like distance. It is like why are you using the car? Use of car, personal or business. If you are using it for business, then the insurance cost will be more. If you are using it for personal purpose, the insurance cost will be less. So the moment you start driving for business purpose, the insurance cost goes up. Okay, so use of cars, personal and business, will determine, right, how you're using it. Okay, then few other points. If you have higher deductibles in the policy, the insurance cost will be lower. Lower is your share of payment, right? Higher will be the insurance cost. Higher is your share of payment, that is deductible, right? Then lower will be insurance cost. So higher deductible usually lead to lower costs. Okay, finally, if you're leasing a car, the insurance cost will be more. If you are like financing the car, the insurance cost will be more. But if you own the car outright without any loan on it, the insurance cost will be less. So in terms of cost, leasing is the most expensive one because you're renting a car, right? So the cost becomes high. Financing, little lower than leasing. If you do not have any loans or stuff, you own it outright, the cost is even lower. Okay. Finally, it will also depend on like policy provisions, like how much accidental coverage you want, all that stuff. So more the policy provisions, higher will be the cost. For example, if you go here, right, see it is $0 deductible. So if you increase the deductible, right, and you can change the limit, so it is 1 million body injury limit, property damage 1 million, right? Then you can change the deductible. Accidental benefits are not there, if you add them it will increase. Family protection is also there. So now it depends on the policy too. There are different policies, I'll explain it here. So all peril means it covers everything. Okay, it includes all the benefit from collision. Means collision pays only when there is an accident. Comprehensive pays when there is an accident along with other things. So all peril means it covers everything, and you can include a deductible in it, so it will help you to calculate. Okay, if you do not select all perils, if you select only collision, the insurance coverage will be like the amount you have to pay will be lower, right? Because they will only cover insurance needs that arise from accidents. They will not cover other things, like if theft happens or vandalism happens, they will not cover it. Comprehensive coverage selects everything, but it's a good idea to get all peril if you can afford it. Otherwise, get the other ones. Okay, so you can modify your coverage, read carefully before buying, and you can change the insurance premium. Okay, all perils is usually more costly. So if you select all perils, it is usually more costly. Any questions? Okay, so let's start with best practices. Best practices that you should follow when getting an auto insurance: try to buy a cheaper car. I would say cheaper, popular car, that will lower your premium. Okay, second, drive safely. If you get speeding tickets and stuff, the insurance cost will be higher, so better to build up a good driving record. And also be a defensive driver, it's always safer. Physics says you can't really make a difference by speed, so there shouldn't be any need for speed. Okay, so driving safely increases your opportunities to save on insurance, because insurance can be very costly otherwise. If you're a new driver or have bad driving behavior, the insurance cost will be extremely high. Okay, so buy a cheaper car, drive safely, try to have auto and home insurance from the same company. You get certain discounts there. Then fourth one, auto insurance also depends on location. So if you are in a safer location, let's say outskirts of the city, versus something like downtown where vandalism is more common, the insurance cost will be higher in downtown area, lower in outside. So if you have an opportunity to show your address like outside the city, it's usually cheaper. Okay, then also try to, if they ask, have an option to get a monitoring device on your car, always subscribe for that. You can save money doing that, right? And it also helps you to create a good driving behavior. Then monitor the deductibles. if you are able to manage higher deductibles, the insurance cost will be lower. Okay, try to own the car outright without financing or leasing it, then the insurance cost also goes down. So these are key points to focus on. Try to buy a cheaper car, cheaper insurance. Expensive car, expensive insurance. Drive safely, okay, without any penalties. Try to get the best driving license possible, class 5 if you're in Alberta, right? Class like G if you are in Ontario or something, because type of insurance determines your premium. Try to avoid suspensions, monitor everything, like focus on not having claims. The more claims you have with the insurance company, higher will be the insurance cost. There is a no claim discount that you can get, so try to get that. Okay, and if you're driving less, then the insurance cost will be lower. So these are best practices to follow when you're getting a car insurance. Okay, so we'll take a small break. Once we're back in 15 minutes, we'll start it. So if not 15, 20 minutes, because like I have to go and eat too. So we'll be like, go have some food, come back, and we'll start with the PowerPoint in 20 minutes. Okay, so I'm recording. So this is the key points of insurance. I'll share the link with you so that you can refer it later on. Okay. The next is we'll cover the PowerPoint. Okay. So we'll go through the PowerPoint once. If any point I want to discuss more, we'll discuss it more. So let's start with the PowerPoint. So we're discussing home and auto insurance. So what are the learning objectives of this chapter? Develop a risk management plan using insurance. Discuss the importance of property and liability insurance. Explain the insurance coverage and policy types available to homeowners and renters. Analyze factors that influence the amount of coverage and the cost of home insurance. Identify the important types of auto insurance and evaluate factors that impact cost of auto. Okay, so what is insurance? Insurance is a protection against possible financial loss. So you approach an insurance coverage like insurance company, they say that they are going to cover you against some possible financial loss. An insurance company or the insurer is a risk sharing firm that assumes the financial responsibility for loss for an insured risk. So they are assuming that they will pay if something goes wrong. People purchase a policy, which is a return contract of insurance, and the firm assumes a risk for a fee called as the premium. Premium is the amount of money a policyholder is charged for the insurance policy. Insured is the person covered by the insurance policy. So the person who is buying the insurance policy is the insured person. Okay, a person who owns the insurance policy is the policy holder. So policy holder and insured can be same or can be different. So if you're buying an insurance policy on your car, right, then you are the insured person. Or let's say you're buying an insurance policy on your life, then you are the insured person and you are the policy holder. But let's say you're buying insurance policy on your wife name, then the wife is the insured person, but you are the policy holder because you paid for it. Okay, so it may be that the policy holder and the insured person can be different. Now there are different type of risk, so let's first understand risk. What is a risk? Risk is a change or chance or uncertainty of loss. Now risk, peril and hazards are different. So risk is the chance of loss, right? Peril is the cause of possible loss, such as fire, windstorm, robbery, disease or death. Hazard is something that increases the likelihood of loss, such as drunk driving, smoking in bed or defective house wiring. So when you deal with insurance contract, you will come across these three terms. Risk is the actual event that is causing the loss, right? So risk is the actual loss, sorry. Risk is the actual loss. Peril is something that is causing the loss. And hazard is something that is increasing either the chance or severity of the loss. Most common risks are classified as personal risk, loss of income, premature death, property risk, directly damage to assets, or liability risk, loss due to injury or harm to others. Pure risk is a risk which is only possibility is loss. Pure risk is a risk in which there is only a chance of loss, there is no possibility of profit. This risk can be insured. So it is insurable, accidental, unintentional, and nature of risk can be predicted. Speculative risk is the risk of like chance of loss or gain. So investment is like a speculation. You can either make money or lose money. So investments cannot be insured, right? Because there is a possibility of gain. This is uninsurable, such as starting a small business or gambling. So there are different risk management technique. So what is risk management? Risk management is a long range organized plan strategy to protect your assets and family. Risk management can reduce financial loss and improve your chances for economic, social, physical, and emotional well being. Cyber insurance and identity theft, right? Insurance are relatively new to the marketplace but have grown due to increased threat of cyber attacks and identity theft. Now, banks will generally give you a call. Like banks have like companies that are associated with them, and they're providing insurance against like identity theft or like something going wrong on the internet. Due to reliance on the internet for companies with an online presence, they must ensure they cover the cost of business due to breach, right, or hacking or something like that. So if you're running a business, it's and especially an online business, it's a good idea to get yourself insured against online threats. Individuals should insure for losses that might occur due to identity theft. Now, what are the different risk management methods? So, risk avoidance is there. Risk avoidance means to avoid the chance of loss altogether. For example, if you do not want to take like car insurance and don't want to risk your life, just avoid driving. So, avoiding a car incident accident by not driving to work. That's a way of risk avoidance. Risk reduction means to reduce the chances of loss occurring or reducing the adverse effect of loss that do occur. Like installing smoke alarms or fire extinguisher is an example, wearing a seat belt to avoid serious injury if you are in an accident. Risk assumption. Risk assumption means taking on the responsibility for loss or injury. So risk assumption is self-insurance. So you keep aside money, and if something goes wrong, you use that money. So that is risk assumption. To self-insure is the process of establishing a monetary fund to cover the cost of loss. Risk shifting means a way of transferring the cost of loss to an insurance company. So in risk shifting, you like transfer the cost of insurance or the possibility of loss to an insurance company by paying a small premium. So they have given an example, right? So if you have disability, a risk that everyone faces. So what is the financial impact of disability? Loss of one income, loss of services, or increased expenses due to disability. Personal resources like savings, investment, and you following safety precautions can help you deal with risk. So doing this helps to avoid this risk or decrease the severity of risk. Private sector, there is disability insurance, and public sector, you can take payments from CPP and EI if you're disabled. Now, important point, lot of people will discuss this more in the life insurance chapter. Lot of people do not think about disability. They do think about life insurance, but statistically, it is more probable that a person will have disability rather than death. So a person is statistically more probable to have a disability than death. So it's a good idea to have a disability insurance. More important even than life insurance. Life insurance is important, but along with that, disability is also equally important. Then there is a risk that you might have some illness. So it might result in loss of one income or large medical expenses. So how do you what personal resources do you use to reduce this risk? You do health enhancing behavior, having good food, exercising regularly. Private sector, you can have health insurance to cover this risk. Public sector, you we all have provincial plan. So in Canada, the healthcare is covered by the provinces, so you have Medicare plans to deal with it. There is possibility of death, so in the event of death you have loss of one income, loss of services, and funeral expenses, right? Personal resources you can use, you can do estate planning, you can reduce the risk of death. Life insurance, like private sector way, you can have life insurance. In public sector, if you are a veteran, if you are serving in the army, then you have veterans life insurance. There are different government programs like survivor benefits and CPP death benefits. Okay. Next, if you own some property, there is a property loss. So, a catastrophic storm can damage the property, then you can have repair or replacement cost of that, etc. Strategies for reducing financial impact: property repair and upkeep, right? That is one personal resources that you can use, personal strategies that you can use. You can install security or alarm systems to reduce the property risk. Then private sector, you can have auto insurance, homeowner insurance, tenant insurance, depending on what applies to you. Public sector, you might get some disaster relief if there is flood or something. Liability is claims and said like harms done to others. Liability is harms caused by your actions, intentional or unintentional, to others. So it can be claims and settlement clause, lawsuits and legal expenses, loss of personal assets and income. How do you avoid or reduce liability risk? Observing safety precautions, maintaining the property to standards, right? Important liability arises in the winter months in Canada, right? You are supposed to, right, clean or remove the snow from the driveway as well as like the public street that is near you from the curb. If you're not doing that and if someone has a fall, then it is your responsibility or you are liable for that. So it's important to understand it. Now, planning an insurance program, because individuals have their own needs and goals, many of which change over the years, a personal insurance program should be tailored to those changes. In early years of marriage, when a family is growing, most family needs certain kind of insurance protections. Later, when the family has higher income and a different financial situation, protection needs change. So when you are young and you have a lot of dependents, young dependents on you, the insurance need for your family will be very high. But as you age and the dependents are not anymore dependent on you, your let's say kids and stuff, then the insurance need goes down. Still later, when the children have grown and are on their own, retirement and health coverage becomes a consideration, further changing the family's personal insurance program. So, how do you do insurance planning? Set insurance goal, sit down, find out what kind of risk you have. If you have a house, you have a risk to that. If you have a car, you have a risk to that. If you have an income source, you it can like be due to like it can stop due to death or disability. You can have a critical illness that will have a lot of expenses. So all of this risk you have to note down. Then you have to develop a plan to cover these risks, then put your plan into action and then you check your results. So step number 1, set your insurance goals and prioritize them. Set up a plan in motion to reduce the impact of following events: loss of income due to death, illness, accident or unemployment, loss of income and extra expenses from illness, disability and death of spouse, additional expenses that might occur because of injury or death of a family member, loss of real or personal property due to fire, theft, or other hazards. There could be potential loss of income, savings, and property due to personal liability. So, these are some risks that you have to start thinking about. Then develop a plan to reach your goals, that is, have strategy how you will reduce the risk, how will you transfer the risk using insurance, and then create an insurance strategy for you. Then put a plan in action. To put your risk management plan to work, ask yourself what should be insured, how much insurance do you need, and what kind of insurance and from whom. Review your results. Remember that things change throughout your life and it is important to review it. So first is property and liability insurance. So there are potential property losses. The main risks related to home and cars are property damage or loss, and your responsibility for injury to others and damage to property of others. Home, automobile, and other personal belongings represents a substantial financial commitment. The risk of physical damage caused by perils such as fire, wind, water, and smoke can create issues. There is a risk of loss, right? Because you might not be able to use the property if it is damaged. Liability is important, especially in home insurance, because liability is a part of it. So what is liability? Liability is a legal responsibility for financial cost of another person's loss or injury. It can happen due to negligence. Negligence is the failure to do what a reasonable and a prudent person would do in a given situation. There is strict liability. It is present when a person is held responsible for intentional or unintentional actions. There is vicarious liability is when you are held responsible for actions of another person. Homeowners insurance is the coverage for a place of residence and its associated financial risk. It includes physical damage to property and loss of use of property. Okay, buildings and other structures are included. Home insurance also covers additional living expenses. So if you are not able to use your property and you have to rent while the property is being repaired, then they will cover that. There is also personal property and articles like personal property endorsement and house inventory that they might cover. So basic coverage is building and other structures, personal property. Then because your house is damaged, you might have to live in some other place, right? So they cover additional living expenses, and the home insurance also covers liability that might arise at your place if someone else is harmed. So all the inventory you have to note down and submit it to an insurance company. Have records, meticulous records of everything you own, especially property you have in the house. Homeowners insurance can be a replacement value of your home. So the limit of insurance purchase should reflect the cost to rebuild your house, not its current market value. It is done by appraisal and it is generally inspection by the company. So if something happens, they will replace your house to the situation it was before the damage. Then sometimes they might give you depreciated value. So it is the cash payment that they give based on a reduction in value of an object based on its age and percent it has decreased over the years. Personal liability is also important. So it protects you and your family from financial loss resulting from legal action against you due to damage to others and their property. It includes the cost of legal defense. It might include voluntary medical payments and voluntary property damage. You can get an umbrella policy. It is also called as personal catastrophic policy. Umbrella policy is a liability policy. It basically supplements the personal liability coverage. It is 1 million in or more in liability coverage. Then there are specialized coverages too. Homeowners insurance, in fact, the most common insurance in general, it won't cover special risk automatically. Area specific risk includes earthquake, flooding, bushfires. Those with a need of that kind of assurance needs a related rider or addition. So it means like natural calamities on a big scale, like sometimes the insurance companies do not cover that. So do check with your insurance company before buying an insurance, right? Especially if you're living in BC in a fire prone area, that you need to check with your insurance company beforehand whether they cover that risk or not. If they're not covering that risk in the traditional policy, you can pay extra and get additional riders. Riders are add on to insurance policies. So they add features to your insurance policy. They cost, of course, they are not free, but you can buy those riders. Until recently in Canada, the only insurance coverage available for flooding is caused by sewer backup. Some Canadian companies have recently introduced overland water coverage insurance, which covers some flooding. Tenants insurance. So if you're renting a place, this applies to you. It includes personal property loss or damage, right? If something happens to your like your own property as a renter, it covers for that. It covers personal liability that might arise when you're renting. It covers additional living expenses. If the place that you're renting gets damaged and it is taking time to repair, then you have to probably stay in an hotel or in an Airbnb, then the insurance company covers that. Landlord's insurance usually won't cover personal belonging of a tenant, so it's important to get coverage. Tenant's legal liability covers loss or damage to the property in your care or control caused by fire, smoke, explosion, or water damage. Types of home insurance forms include name peril and all this. So when you're buying an home insurance policy, you can either get all risk policy in which everything is covered unless it is specifically excluded, or you can get name peril. Name peril means they will give you list of things that they cover. Anything outside of that, they will not cover it. Only those perils specifically listed in the policy are covered in a name peril kind of home insurance policy. In an all risk policy, all events are covered unless they are specifically excluded. Different coverage types are combined in a package form, standard, broad, or comprehensive form. Extension of coverages are available for other losses. Okay. Important to note, in an home insurance, not everything is covered. Articles separately described and specially insured against, like such as jewelry, fur boots, or expensive electronics, is not covered. You have to include them as a special rider, so you have to pay extra. Animal, birds, or fish are not covered. Motorized land vehicles, except those used to service an insured's residence that are not licensed for road use, are not covered. So if you have, let's say, I'm just throwing in some gardening like equipment that you can drive, then that things are not covered. Any devices or instrument for transmission or recording of sound, including any accessory or antenna, while in or motorhomes vehicles, are not covered. Aircraft and parts are not covered. Property of roomers, boarders, and other tenants not related are not covered. Property contained in an apartment regularly rented. So if you are renting a place, you have to mention it in the insurance policy. If you are not mentioning, it's not covered. Property rented is not covered. Business property is not covered. Pertaining to business, right, generally not covered. Okay. So common combinations that you can buy when you're purchasing a home insurance. So standard policy is, you in buildings you have name peril, so they will give a list of things that they cover for the building part. And content, it is name peril, so again they will give you a list of what can they cover. You can get a broad form insurance in which all risks are covered in building, and in content name perils, that is things they will include, right, will be covered. Comprehensive form of home insurance, everything is covered. The whole entire building, anything happens to it, will be covered. Content, everything will be covered. Comprehensive form of home insurance is generally very expensive. Exclusions are like small print. Pay attention to them because they are part of what defines your insurance policy. Insurance companies use exclusion to help limit the risk they assume for the policyholder. Deductibles we discuss. Deductible is a share that you pay when the claim arises. It is a fixed amount indicated on policy. The amount of deductible is often $100, $250, $500, or $1,000, and your insurance company will subtract that amount from your claim. Higher your deductible, the lower your premium, since the insurance company is responsible for less of your loss. So if you increase the deductible in your policy, the premium of that policy will usually go down. People are generally more careful if the cost of being careless is higher. That's the reason companies do that. Fewer smaller claim also mean less administrative cost to the insurer. Next is, how much coverage do you need? Determine what it would cost you to repair or rebuild your home and purchase a limit of insurance equal to this amount. Have sufficient liability coverage, right? Because liabilities are important. People generally do not consider that unless it arises. It includes protection for specific items such as collection, cameras, and jewelry. Determine the amount of content of your home, actual cash value, less cost of depreciation, replacement value, repair or replace with new items of similar kind and quantity. So figure out like all the contents of your house, calculate the expected value of them, and then get an insurance. Now we discuss this. What are the different factors that impact home insurance cost? Location of residence. If you're living in a place where there are frequent burglaries and stuff, right, then the insurance cost will be higher. Type and age of structure also determines that. Amount of coverage and deductible. So if you have a newer home, the insurance cost will be lower. If you have an older home, insurance cost will be higher. Amount of coverage and deductibles. If you have higher deductible, the insurance cost will be lower. Replacement value usually has a higher cost than depreciated value. Type of electricity, heating type, plumbing, age of roof, other factors like alarms and pools that you have, all of that will determine insurance cost. How do you reduce home insurance cost? Take discount for alarm systems, smoke detectors. If you insure your car with the same company, you get additional discount. There are differences in the companies too, so compare cost and coverage. Customer satisfaction is important. Any questions till now? Okay. Next, all provinces and territories require mandatory auto insurance. So auto insurance covers risk associated with owning, operating, or using a vehicle. So it includes three parts: liabilities that you might cause to others, right, for injury, death, and property damage; injury, death to yourself or your passengers; and damage to your vehicle. So different risk and insurance coverage. So risk to yourself and your passengers generally covered using accidental benefit provision of an automobile policy. Damage to your vehicle, so it can be comprehensive, that covers everything, or collision, that only covers accident. Liability to others, right, such as death or property damage, it is generally covered using third party coverage. Now, third party coverage is legally mandatory. These two are not, but good idea to take them. There is no fault concept, which are widely misunderstood. Fault is determined in every incident for the purpose of premium calculation. So if you are at fault in any claim, then the insurance premium will go up. If you're not at fault in any claim, then the insurance premium like doesn't go up. Each driver collects from their own insurance company medical expenses, lost wages, and related injury cost. Damage to your vehicle, to the extent you are not at fault, right, that can be collected. It is intended to provide faster settlement of claims and reduce costs. System varies from province to province. So motor vehicle coverage. Most of the money automobile insurance company plain claims is spent on legal expenses of lawsuits, medical expenses, and related costs. The main bodily injury coverage are liability, accidental, and uninsured motors protection. So major costs that the companies face, insurance companies faced, is harms that are done to others rather than the car damage to cars and stuff. Because if a passenger is driving and if he or she hits someone, then that person can sue for millions of dollars. So that is the main cost that they bear. Third party liability covers the risk of financial loss due to legal expenses, medical expenses, lost wages, and other expenses associated with injuries, as well as property damage caused by accidents for which you were responsible. Accidental benefit covers the cost of healthcare for the person you are injuring along with yourself. Uninsured motorist protection. So if you are in an accident caused by an unidentified person, so it's an hit and run case, you are not able to find the person who did damage to you or your car, then also you are covered, right? So there is a protection provision in your insurance policy. So if something happens to you and the person is not identifiable, then also the insurance company is covered. Protection is provided for bodily injury claims if the driver is unidentified and uninsured, but covers only damage to a vehicle if the driver is identified but uninsured. So that is important. So if something happens and you are not able to find the person, or you are able to find the person but the person is uninsured, then the insurance company will cover the car damage, and something happening to you, you have to sue that person. Property damage. When your automobile is involved in an accident, property damage coverage insures you against damage to your own vehicle, typically through collision and comprehensive damage. Collision. When your car is in an accident, collision insurance pays for the damage to your automobile. Amount collected is limited to the actual cash value of the car at the time of the loss. Comprehensive physical damage covers damage to your vehicle that is not caused by a collision, such as fire, theft, vandalism, grass breakage, hail, or windstorm. Okay, so they, like, this is important. So other things that the insurance company covers, so if you have to tow your vehicle and there is emergency roads coverage, so that pays for the cost of breakdown and mechanical assistance. This coverage can be especially beneficial on long trips or during in, so it is nothing but, if you are in Alberta, you can buy something called as an AMA benefit. AMA is roadside assistance. If something happens, like you run out of fuel, something happens to your car, it's not starting in the cold weather, then they can provide you help if you call them up. You can purchase a waiver of depreciation coverage for new vehicle. This insurance allows for waiver of any depreciated value, right, up to 24 months. So, amount of coverage. Factors that affect the amount of premium you pay include legal concerns. Some coverage are mandatory. Minimum 200,000 liability limit and accidental benefits are needed. Higher limits are recommended. So, at least you should get $1 million. Third party liability benefit. If something happens to them, like the third party, then the insurance company will pay up to maximum $1 million. That is bare minimum you should get. Physical damage is optional unless finance contract requires coverage as a security of loan. The automobile itself uses clear system in Ontario, so cost to repair or replace is calculated using that system. It depends on make and model, style of vehicle, and it doesn't depend on color. So there is a misconception that red color cars, or let's say black color cars, are more costly to insure. That is not the case. It doesn't depend on color. Automobile insurance premium factors. More factors affecting the amount of premium. So where you live will impact how much auto insurance you pay. If you live in an urban area, the probability of accidents and car theft are higher. Most likely they increase your amount of premium. Make and style of car. The type of car you drive generally does not impact the premium you pay for third party coverage. It does, however, affect the coverage for physical damage to their car. So third party insurance claim depends on your behavior, your driving behavior, but comprehensive or collision depends on what kind of car you have. The more expensive car, the higher will be insurance cost in that factor. Insurance company rate vehicles according to their safety record and cost to repair or replace them. Automobile insurance premium factors. More factors affecting the includes use of vehicle. So if you're using for pleasure, business, or farming, that will determine the insurance. Business and farming, the insurance costs are higher. Pleasure, it is lower. Distance you drive to work. Lower you drive, like lower will be the insurance premium. Rating territory. Accidents, theft, and vandalism rates in the area where you live, right? Insurance is generally higher in urban areas, lower in rural areas. Driver classification, age, gender also determines insurance. Females have a lower insurance cost in auto and life than males. Males have a statistically higher probability of getting into accidents, so that's the reason, right? Females generally have a lower insurance premium. Age, gender, marital status, driving records, and driving habits determine your insurance. Assigned risk pool of people who are considered high risk drivers. Reducing automobile insurance premium. So find out how much it will cost to insure your car before buying it. Compare different companies. You can increase your deductibles to reduce the cost of insurance. Look for discounts. Establish and maintain a good driving record. Install security devices such as car alarms. If you have more than one vehicle, insure them both with the same company. Okay, so that completes the chapter. Any questions? Okay, so that covers insurance chapter. So let me stop the